if someone said, all I care about is the house, right?
Yeah.
Then it would be like, okay, you need to set some money aside and save it and try to have it grow for a down payment. Or the more you reduce your debt, the easier it'll be to get a mortgage loan.
Hi, everyone. Welcome back to the podcast. We have a very, very special guest, Mr. Stephen Mulholland. And I'll give everybody a background on this incredible human being and what he does and literally how he can help you, give you some general tips on how to set yourself up, either get yourself out of a hole or set yourself up for success. And before we go into the podcast and talk about all the things about money and finance, Stephen, introduce yourself. Tell us a little bit about yourself, what you do, how you do it, and just who you are in general. Tell us.
Thanks for the warm intro, Chris. Hi, everybody. My name is Stephen Mulholland. I am a CFA charter holder, which stands for Chartered Financial Analyst, and Certified Financial Planner, CFP. I'm an equal partner, owner of a registered investment advisor here in San Diego. And we'll get into what all those acronyms actually mean in a little bit. So I run a registered investment advisor here in San Diego, helping individuals. Yep. And previously I managed a hedge fund in New York for 7 years. And before that was the sole analyst of the James Irvine Foundation. So the foundation has over $2 billion, and my job was to make money for them so they had more money to give away. So I'm particularly proud of that experience.
Out of all of that, you know what I took away from this, Stephen, and I've talked to you a lot of times, you know what you're doing. That's all I took. I don't even know what any of that means, but good for you. Now I feel even better about this podcast. But yeah, we got a winner. So Stephen, I appreciate you. And if you don't mind me sharing, Stephen is a client, and we talk about finances pretty regularly. I mean, it's just a normal thing. And you know, I always like to explain why we brought up this podcast so people can put it into context. And there's a lot of content on the internet, and I think understanding a little bit more of like why this is important and like how this came upon, like it gives people a little bit more context and they can digest it a little bit easier. So you and I were talking, and you know, we have physical therapists here at Sports Performance, and I work with a lot of physical therapists in terms of mentoring and putting them in the right direction. And most people, when they go to school, and I don't know about in your domain, when they go to school to become a physical therapist, right? We always aspire for the outcome, which is like the degree, and like we want to have this incredible life that we all dream upon. But the challenge is, in order to get to that life, some of us have to go into debt in order to do that. Some are very fortunate to have less or more debt or whatever it is, or no debt. So regardless, we all are aspiring for like the thing, the outcome. We all want to be somebody with this amount of money that we all like dream upon. And I'm sure you talk to a lot of people who have different visions of what they want to do. And in the physical therapist world, whether we have debt or not, we're all in the same playing field. We all want happiness, and we all want like a certain lifestyle. And so there are certain scenarios that we see with physical therapists, and we've talked to physical therapists here at Sports Performance, and you had some really good information that I think can be applied to anybody on this planet, especially the people in our world who are physical therapists who want to have a certain lifestyle. And you have some great principle level stuff, high level stuff that doesn't have to be too fancy. Like I mean, the acronyms that you used, I think we need to learn what those are to help people down the line. But you know, I'll start off this podcast, Stephen. You said not everybody needs a financial advisor or a wealth management, or, I mean, I don't even know these terms. Like, this is your world. Like, some people are like, they are accredited and some people are not. And we'll talk about that. But in your world, you said that there are certain times in life that somebody should consult or hire somebody in your position. A financial advisor, somebody to help direct them in life. And let's start with that, because I think it's very important. The tips that you said to our team downstairs will resonate with a lot of people. I think you said there was 4. Do you remember last time? Yeah. So go ahead and give that to us. What do you think?
Perfect. And if you hear anything overhead, the Blue Angels are flying right over my office. Yeah. So well said, Chris. And it's actually particularly relevant for a few reasons, but one of them is a physical therapist who literally had the full menu, right? Debt to go through school, credit card debt because the debt put her in a hole through school, debt for her home. And this individual who was introduced to me was given the opportunity to invest in a practice and go from an employee to an owner. So she looked at her finances and said, well, I don't have the money. Where am I going to get the money? And to use the phrase you used earlier, which is perfect, around debt, which is a hole, right? She realized she was in actually 3 different holes, right? So to your point and to your question about who needs a financial advisor, and really it's about when you go up the complexity curve, right? So in her case, so I did a bunch of work for her. We met a few times in person, pre-COVID. And I actually ended up not charging her anything. And I looked at every avenue under the sun, right? What her interest rates were, consolidation of debt. And the recommendation for her was so simple. And because I empathized with her hole, right? You don't walk by, at least I don't think you or I would, you don't walk by someone in a hole and throw dirt in, right? So if I couldn't get her out of the hole, I at least didn't want to make it worse. So I charged her nothing. And my advice to her was to pay down her debt, starting with the credit card debt. Credit card debt can be double digits. You almost should never use credit card debt, right? It's okay to use credit cards for points. I do that myself. Every purchase goes on a credit card, but then you pay off the balance every month, right? Then you're winning, right? Again, you're out of the hole and you're getting something for free. So the reason I was super interested to do this podcast with you today and speak to this community is I've gotten into the weeds with a physical therapist. In my career, so you mentioned a lot of lofty goals for when someone gets started in physical therapy. And I would say, even though I'm in finance and the 2008 recession, some of the shenanigans that go on in Wall Street, a lot of the financial industry gets a deservedly bad rap, right? But one of the reasons I got into finance, as you were sketching out, beyond providing for the family, money, interest, was to try to help people. And when I think about careers where the main motivation is to help people, physical therapists are top of the list, right? So I'm hoping today to give advice that will help physical therapists for free. And I've actually, this isn't hypothetical, I've gone through into the weeds with this. So the 4 examples you mentioned, right? Typically, and we'll come back to some conclusions from that woman's story, because I think another important part is with finance, there's sort of the financial planning side and then the investing side. On the financial planning side, it's totally personal, right? So, so in this woman's case, even though she had mountains of debt, she said something to me at the end that was really profound, right? She got really sincere. She thanked me for the work. And she said, you know, in spite of all this debt, I love my job and I love my house, and the debt was worth it. So that's the other part of it, right? Is it really is situation by situation. And on the investment side, and we're going to get into this, you know, we can talk expected returns, risk, and all that stuff, but it is going to be completely different depending on the individual, the family situation. So the 4 things: kids, inheritance, stock of your company, and when you own your own clinic, part or fully, right? So when you have kids, typically when you have kids, you look around and you say, wait, I needed life insurance. I need, you know, what? Oh, I might need a will or an estate plan, right? I might want to say, right? I might want to save for the kids' education, right? And when it comes to money, you know, the sooner you start, right, the more the money can compound. The lower the hurdle gets, right? So kids should be one of the triggering events, right? Not necessarily you need a full-time financial advisor, right? But you should probably, to your point, if you're do-it-yourself oriented DIY, you can go online and do a lot of research yourself. And we'll get into this later. But when you made the comment about there's a lot of content online, the trouble is a lot of that content is oriented around marketing, right?
1000%.
the most successful firms in finance are wonderful marketing firms. Some of them are wonderful investors. Some of them are terrible, a lot of in between. The one commonality all the big money management firms have is incredible marketing, right? So if you're, a minnow swimming in the ocean, right, you have to meet two tests. You have to read the content, understand it, and then you have to decide, right, is it true, right? Is this good advice? And what's the angle of the person writing it, right? There's a whole ecosystem now. There are whole firms that all they do is write articles for the sole purpose that when you read 5 or 10, they say, oh, hey, Chris, we noticed you're trying to answer some financial questions. What if we refer you to an advisor, right?
I see.
I called up one of these firms because I was curious, and I said, how do you screen the advisors that you recommend for clients?
For sure.
And the guy said, well, whoever pays us the most money, right? I'm not going to name who the firm is,
of course,
but I also think it's sort of emblematic, right? And I mean, they're a company, for-profit company. You can't necessarily blame them for that. But the average person reading that article has no clue, right? That they're swimming in the ocean. There's a great white shark over there. There's So number one, kids. 2, inheritance, right? Which is especially prescient with boomers and millennials. That's a big topic these days. The stock of your company. This maybe is less of a fit for a physical therapist, but let's say you're an entrepreneurial guy, right? Let's say through your practice, you invest in a product, right? Or some kind of web service related to PT, right? You may find yourself with pre-IPO stock, and maybe the company IPOs. Anytime you're dealing with stock in a private company, you have incentive stock options, restricted stock units, employee stock purchase plans. Even for someone in finance, it's a lot to get into and keep track of. So kids, inheritance, stock of your own plan, and when you own your own business, right? When you put money in a 401k, which I know you encourage all your employees to do, which is the right move, the most that they can contribute is $19,500 per year, right? Suddenly, when you own your firm, the number goes up to $58,000, right? And if that's through an individual 401k or a solo 401k, when you get up to cash balance plans, suddenly you can put hundreds of thousands of dollars away. So really, kids, inheritance, private stock, owning your own business, all create more complexity and also opportunity. And most of the opportunity comes from tax planning, right? Minimizing taxes in the interim so you can maximize your returns over the long run. So those would be the 4 scenarios.
So, and people listening to this are going to be in different spectrums. And we have listeners from all over the country and all over the world. And we're all the same. We're all humans, right? We're all working towards something. And they're going to hit these things at different points. Some may hit it never. Some may hit it early on. And so when we have students asking this question, should I go to this school? It's expensive. I need to take out debt. Then we have people who have gone to certain schools and have more or less debt. Everyone, let's assume people have debt and they're listening to this podcast and they're like, listen, I want to live I shouldn't even say American dream because there's people all over the world, but the dream, right? Their life dream. I want to own a home. I'm going to have kids. I may or may not inherit something from my family or something else. And a lot of people ask, do I need a financial advisor? And that's when you would say an easy answer is, have you achieved any of those 4? So if we have, say, a new graduate or a student, 27, 28 years old, has debt, maybe hasn't bought a home yet, doesn't have kids yet, and hasn't had an opportunity to invest in a company or be part owner. So they have the debt with no kids. So it becomes, this is the challenge. Like this is the ultimate profile of a physical therapist, a starting physical therapist. Now, you and I have talked about this. Where do people start? Like, should they hire somebody from the get-go and like narrow down? But like you just told me a story about somebody, like literally you didn't charge this person because the equation was easy.
Because she was exactly the person, the description that you just laid out. She fit that to a T.
Absolutely.
So, so married, no kids yet. She was exactly in that that phase in her life. So Chris, if for someone in that situation, I want to give you a handy framework that I'm gonna use as few numbers and keep it as simple as possible.
Please.
Yeah. And not because when you listen to a podcast, hey, you might be working out or driving. Let's keep it simple. What kind of interest rate do you think these days on these physical therapy loans is common?
Let's go 5 to 10%, consolidated at 7, 8.
Okay.
Let's do
perfect.
That. Yeah.
So picking up right on that, consolidate your debt if you haven't, right?
Wait. So do you recommend, and guys, don't get legal on me. Like, this is just advice and recommendations from professionals here. Like, don't say like, hey, this guy on this pod. No, don't do that. This is just general. Okay. So first, let's start there. Do you recommend that people consolidate? I know this might seem very fundamental for some people, but clarity and opportunity. So do you recommend that people consolidate?
Absolutely. If they can, so to your point, and again, this the woman I dealt with is such a perfect example.
Yep.
She had different student loans at different rates, right?
See.
So sort of an easy home run was, directly contact the lender and and pay off the high ones first. And even that was such simple advice. Again, I didn't feel right charging for that.
I understand that.
But when you're juggling 3 school loans and a credit card debt and a mortgage, and this question of can I take on, like, this woman was so passionate about her practice, she wanted to take on more debt to get into right. And but I don't think she's unusual, especially if if you start with student loans that are sizable, 5 figures. I mean, you're starting behind the starting line. But anyway, she was so overwhelmed that even that basic point is kind of like, where do you start? So this is a great place to start. Is consolidate your debt. If your credit cards are 18, get rid of that. You don't have credit card debt. If you have multiple student loans, pay off the higher ones first or consolidate. Call your lender, right? If you have a lender at a better rate, see if they'll give you a bigger loan to get rid of the others. A bonus mention, can't remember if we talked about this, Chris. There's a thing called a friend and family loan.
Tell me more.
Yeah. So I really genuinely hope for physical therapists and for young people, for the country, I think it'd be wonderful if there's student loan debt relief. And hopefully there'll be something. But assuming it's not all wiped away, a friend and family loan can be a really great option. So a friend of mine who went to private law school and came out to become a lawyer right around the financial crisis was saddled with a lot of debt. And his father, typical baby boomer, owned a home in California he bought in the 70s. It's gone up a lot. Big investment portfolio. It's done incredibly well. So he said to his son, he said, hey, if there's a way I can, give you some money to pay off your student loans, right? Or loan you the money, I would do that, right? And banks are paying 0, right? So my friend's a lawyer, so he looked into it. It turns out the IRS publishes a table of interest rates for friends and family loans. It's 1.5% to 2%. It gets updated pretty regularly. I can send you a link if you want to put it in the notes. But excuse me. But the if you get a loan from your father, an uncle, a cousin, and I actually think there's kind of a nice intergenerational aspect to this, right? There's a lot of stuff in the media about millennials and Gen Z against boomers. Boomers say millennials are lazy. Millennials say, hey, boomer, I just want the life you had, right? So this is kind of a nice intergenerational thing you can do is let's say the father takes $50,000. You can write a promissory note. You can either do it yourself or hire a lawyer to do it for a couple $100. So let's say you have a 7%, 50,000 in student debt at 7%. If your father, your uncle were to give you 50,000, you could pay him, say, 1.5%. Write it up in a promissory note. Retire your 7% debt. Okay. Now the lender, the father in this case, he's getting 0 at the bank. Now he's getting 1.5% on the 50,000, right? And that the difference between 7% and 1.5%, all that interest you save, you can start paying the principal down. So there's actually a formal program sanctioned by the government
Huh.
where, and it's friends and family. It can also be a friend, right? Maybe you have a friend
Yep.
that went to work at Silicon Valley, right? Works at, had a huge home run. This
Yep.
is a nice way to sort of pay it forward. So it's a friend and family loan. If anyone were to Google the IRS friends and family loan, they'll find information. I can also send a link.
Awesome.
But
Awesome.
yes, the first step for the prototype we're talking about, get rid of the high interest rate debt, consolidate the debt, and also consider a friend and family loan.
Nice.
And sometimes someone might not pop immediately in your head, right?
Yeah.
But maybe there is someone if you think about it. So anyway, that's one other idea.
That's
and
huge.
And I want to come back to what you said too, Chris, just to clarify. When you were saying we're just two guys talking on a podcast, I'm not soliciting for business here. I'm genuinely trying to help people I know, trying to help
for
people.
Sure.
So, yep.
Full transparency. I brought Stephen on because of that. We both love sales. There's no argument about that. Sales.
Well, I'm the student. You're the teacher.
I'm very, very passionate about sales, and Stephen and I have been working together for a while now, and just understanding his full transparency, just the advice that we've given to our team members here at Sports Performance, and having those discussions. I think this can benefit the rest of the planet. I think because you got some useful, very helpful information that is very relevant to us. It resonates with us as a profession. The challenge is that a lot of us start in a hole, and that's just the nature of our product. That's the nature of our education, and a lot of private schools, and it just makes it very, very competitive. So thank you for that. That's very important for people to understand.
And let me turn back to the numbers. So I realize I didn't deliver those after a nice build up. I'm going to give you three numbers, Chris.
Okay.
4, 5, and 10.
4, 5, and 10. Tell me.
Historically, if you let the U.S. government borrow money for 3 months, they would pay you 4% for that loan.
Okay.
Through the long arc of history, 100 years, 50 years, right? If you let the U.S. government borrow money for 10 years, historically they'd give you 5%.
Okay.
If you put the money in the stock market, historically you've gotten 10%, right?
Fair.
So that's the history. That's 1900 until 1999. And things have been a little more adventurous through the dot-com bubble, the Great Recession. But more or less, the 4, 5, and 10 are kind of, I don't want to say laws of finance, but when the last 10 years, the stock market's returned 15%, which is 5 per year more than average, right?
Yep.
We basically borrowed it from the future. So if you use models that have high efficacy, high predictive power, R squared, they predict the next 10 years, right? If I were to tell you the S&P did 5% better per year the last 10 years, you'd say, well, maybe the next 10 years will be 5% worse. And if you use the fanciest models, that's the answer.
It makes sense.
Right. So today, if you give the government money for 3 months, you get 0.
Okay.
And if you give the government money for 10 years, you get 1.5.
Wow.
Right? And then if you invest in the stock market, it's likely you'll get 4, 5, or 6%. And that's a bumpy ride.
For sure.
If you can pay down debt that's 5 or 6 or 7, that's guaranteed, right? That's a negative 5% return, negative 6%, negative 7. Forget about 18 of credit cards. And in America, not all debt is created equal.
Yep.
So when you get a credit card loan, no tax benefits, right? Student loan, no tax benefits. Home mortgage, some tax benefits. If you take a loan for investment purposes, tax benefits, right? So a 5 or 6, 7% loan with no tax benefits, if you can retire that's a
huge,
guaranteed return, right? So the stock market, who knows what the next 10 years is going to look like. So we always have that dashboard is incredibly helpful, right? And I've told you this before, so I'm going to give you a pop quiz. If you get 10% a year in the stock market, how many years to double your money?
7.
Perfect. So the rule of 72, any two numbers that multiply to 72 tells you the rate of return and the number of years you need to double your money. So to your question, if this was 2012, right? And this is the unfortunate part. Good financial advice is individual dependent and time dependent. So if 100%. If this were 2009 or 12 and we had this call, I would say, you know what? Buy a home in San Diego, buy some of the S&P 500. That's your priority because you're going to get double digits in the stock market, which crushes 5 or 6 or 7.
Hands down.
Right. But it's 2021. Robert Shiller, who created the Case-Shiller indices that literally give us data about how to assess the returns of housing, right? So he has an index, and I know we have global listeners, but you're based in San Diego. I was just looking at his index for San Diego. So this is home prices over time, month to month for San Diego. The peak, it blew me away, but the peak that we hit before the financial crisis, we didn't get back to even until May 2018. So anyone who bought a home in 2006 or 7 took 11 years to get out from being underwater. Just anyone who bought the stock market in 1999, okay, right? They underperformed bonds until this year, right? So that's 20 years where boring bonds beat the stock market. So the rub, the rub of financial advice is it's person dependent, and it's time dependent,
100%.
right? So to your point, in 2020, and I should make a point, we're recording this on June 25th, 2021. If the stock market falls in half, guys, go ahead, buy some stocks, right? Like when we go ahead, buy some stocks if in place of retiring some debt. And I think one thing I'll add to that is the framework of regret minimization. Jeff Bezos talks about it a fair amount. Like we said, everyone's different. For people who want to minimize regret and make sure they don't make a mistake, right? If you have, and everyone's cash flow situation is different. When you get your paycheck and you pay your expenses, if you want to use some to pay off principal of debt and some to invest in the stock market, there's no harm, right, in taking a multi-factor approach to that, because let's say the stock market continues to do well for a few years, right? You're not kicking yourself saying, well, I'm not participating. And that was the other, from the question you asked, one piece of advice I give any trainer or physical therapist from the beginning is, do you have a brokerage account, right? Because let's say the market crashes like in COVID, right? If you're still kind of at this, I don't know what to do, I have a lot of debt stage, and then the market crashes, and let's say we do this podcast and we say, hey, new advice, it's a good time to buy stocks, right? Well, you have to go online, open a brokerage account. Okay, it's open, I funded it, I filled out all the paperwork, now what do I buy, right? So having the brokerage account and having something in the stock market, right, it is also a really good idea. So once that's set up, now you can allocate.
It's easy.
Right? Yeah. And in terms of housing, which is not easy, the stock market in San Diego, or sorry, the housing market in San Diego, I think I saw a stat that it's risen every month since the bottom in 2012, right? So it's only natural. Everyone who bought a house for the last 8 years, you meet them at the bar or the gym or wherever, they're going to tell you amazing stories, right? I bought a house for $500,000, it's worth $1 million, right? That's the last 8 years, right? That's not the offer you have today, right? There's a thing in economics called a Giffen good. And what it means is the higher the price, the more people want it.
Of course.
The higher the stock prices go, the more the people want it. The higher the house prices go, the more people want it. The downside is the more you pay for a house and the more you pay for stocks, the worse your future returns are going to be.
Makes sense.
So if I could do an anecdote, and Robert Shiller is very big on this, on narratives, right? Is when people talk about the gains they make on houses, they don't tell you the interest they paid. They don't tell you all the money that they put fixing up the house in appliances. When you add all that stuff together, often the returns are worse than an S&P 500 index fund. So anyway, very specific current advice, right, would be to prioritize paying the debt, but also make sure you have a brokerage account. And the other thing would be, don't get bogged down in the details, right? So people will say, where should the brokerage account be, right? Schwab, Vanguard.
Go.
Right. Exactly. Yes.
And I think this whole syrup with, I'm not a name brand person, Robinhood and all these other, like, it's just a different name brand. It's just the same. It's just whatever platform you feel comfortable with, I imagine.
They're all supermarkets. They all have groceries.
Yeah, love that. All right, so it's good to hear that from somebody reputable in the market. You understand it, you get it. It doesn't matter, right? It's just whatever's accessible, easy, whatever you use. Now, you brought up a couple good points, and I think the reality check for a lot of people is I have this debt, okay, and maybe I have credit card, maybe I have a little bit of I looking to buy a house, I have a mortgage, and then I have some student debt, right? Those are all different percentages. Or maybe I just have credit card and student debt. So you have the credit card at 18, and you have the student debt. Let's go 8% consolidated. Okay. So obviously the credit card is the highest, so you got to pay that first. And then you got the student debt. Now you're saying something different because, and there's difference between retirement and investing. So you have this pot that you can allocate to different things, right? Now you're like, do I pay the credit card at 18? Do I pay the student at 8? Do I invest and my company matches so and so dollars? And sorry, do I retire, do a retirement account and they match at whatever percent they do? And then you're like, well, it's nice to like, I want to play with my friends. Like they're putting in money into, I don't even know what the latest fad is, some type of coin. I don't know, whatever the crypto is, whatever. So I want to invest in that. I want to put a couple dollars there and I want to go out and have some drinks on Friday nights. So if you got this pot of like $1,000, after paying down basic expenses, and you're like, man, where do I put this? Do I put it towards the principal on the credit card? Do I do it on the student debt? Do I invest or allocate more to my retirement? Do I invest? And I'm sure this is person dependent, and we've talked about some scenarios behind that, but can you give me a general answer? Like, what is the best for these individuals?
Yeah. Okay. So you said a lot there, but you made a lot
Yep.
of great points. And I'll try to touch on them all. As we said, credit card debt has no tax benefits, whereas mortgage debt does, right? So you bring up an excellent point. You want to consider the tax implications as well as the returns.
Yeah.
So you mentioned the 401k if with an employer match.
Yeah.
So the 401k obviously has one explicit benefit people think about, which is it reduces their taxes. It also has a forced savings mechanism,
Yeah.
much like buying a home can,
Yeah.
right? It's amazing when something disappears from your paycheck that you just live with what's left. Yeah, you're right. You don't think, oh, I'm poor this month.
Sure.
Somehow it all equilibrates to the same thing.
Yeah.
So and this, I know you said don't make it individual, but
yeah.
To do it slightly, that's another variable is, are you a good saver? Like I'm a natural saver, right?
Okay.
And I think you are. So when my paycheck comes in, I get excited about hitting those different accounts, right?
Yeah.
Oh, my son's education account gets a contribution, right?
For sure.
I get excited seeing the 401k balance grow.
Mm-hmm.
Not everyone's that way, right?
Right.
Generally, though, some forced savings mechanisms, whether through the 401k, the house, I mean, that's probably the main reason so many Americans have so much of their net worth in their house, right? Is that they literally, it's difficult to get or they can't get it. So if you need, taxes for savings, that all comes into it. In your scenario, yes, go out and get drinks. I mean, I know you and your family are the same, but my wife and I take really nice vacations every year.
Absolutely.
I mean, the purpose of life is to enjoy it and take care of your family. And I think it goes to the story, the woman that I tried to help, I wouldn't have made her decision, right? But I think the home for her, like for me being a renter, my richest client, right, drives a used Toyota Avalon with 200,000 miles on it and rents in Isla Vista next to all the college students at UC Santa Barbara. And you know what? He travels all the time. He's retired. He has a great life, right? But for this physical therapist I spoke to, having that home, even before kids, meant that much to her, right? So much is, but if we're leaving the individual out, 401k with the match is free money, right?
So take that.
Take that. 401k reduces your tax bill, and most people don't notice. So actually, that of your questions, probably that. If we had someone that said, I really want to pay down the debt, but should I give up the 401k to do that? I would say no.
Okay.
Right. Now, if someone said, all I care about is the house, right? Then it would be like, okay, you need to set some money aside and save it and try to have it grow for a down payment. Or the more you reduce your debt, the easier it'll be to get a mortgage loan, right? So if someone's 100 out of 100 on one of these, right? go for that. But ignoring the personality differences,
Yeah.
the 401k has tax benefits, employer match, and forced savings.
Yep.
That's a home run. So I would always just from a financial standpoint,
Yep.
that would be first in the line, right? So
Perfect.
you took out the really high rate stuff.
Yep.
You've consolidated your debt at a low rate. 401ks right there is just as important. Yeah, absolutely. And yeah, and again, the credit card debt, we've said it a bunch of times, but don't be in credit card debt.
Yeah, get rid of that. Right.
Yeah.
Like, and so this is where I've gotten this question even from team members and other physical therapists. You know, they have debt and they have student debt. Let's assume they don't have credit card debt. They have student debt and they're trying to pay that off. And, you know, a big question is, should I put more towards my retirement or towards the principal of the debt at 8%? And even if you get an employer match at 3 to 5, 6, 7, 10%, whatever that is, I mean, do you pay on the principal of extra payment on the principal of the loan, or do you go investment and add more? And I'm sure that's market dependent, but in general, what would you do in that scenario?
Both. I mean, that's
not drinking on Friday night. That's you're not having that meal. You're skimping. That's like ramen for dinner. So in an ideal world, you're paying down extra on the student debt, an extra payment per year or whatever that is to pay down on the principal. Plus you're putting, that's like a financial, somebody who's savvy, who's like looking for the long-term vision. They can play the long game.
Sure.
They're there for extra retirement plus paying off the debt. They're not looking at like short-term gratification of like, I want the new shoes or I want to go out this weekend or whatever it is.
Right. And that person is more in danger, right? Because they're probably also, I mean, that's the choice, right? You have to be willing in some sense to forestall some gratification.
Yeah.
Right. If I guess you're doing a favor to your future self, right?
For sure.
I would think physical therapists and trainers have an inclination to understand that, right?
Yep.
About how rewards and benefits compound and the importance of health. I mean,
Yep.
people put financial health right below physical health, right? In terms of well-being, causes for divorce, right? These are pretty important things. But yeah, in that case, I would probably just say split the difference, right? Because the thing is, the stock market's been overvalued for a while. It got more overvalued. Right.
Yep.
So like, again, the idea of regret minimization is probably not a bad rule of thumb.
Sure.
But I will tell you, hey, if you're young and single, a physical therapist, how are you going to meet your wife if you don't go to the bar and have drinks? Right. So.
But I have no debt. I understand that. Okay. So, I mean, this is so helpful because people always like, a lot of us just think like very linearly, like, there's simultaneous, like, things that you can do in finance and investing. Always could be moving different parts. The way we think is like, can I just have step one and then step two? Right. And that helps people understand that, especially when you're in a numbers game, it's percentages. And sometimes you get lost in looking at your dashboard. You're like, man, there's just recurring expenses. I don't know which one to do. We're just really good at helping people. We're not really good at planning, right? Like that's just the nature of a lot of times who we are. So you would go down, pay off the student debt, pay off credit card, number one, highest percent, pay off the student debt. If you can, invest in do a retirement account with your company, especially if there's matching. And then from there, you would go into, now, if there's a little bit of free flowing after that, if you have another $200, 1,000 to 500, to whatever that is, do I put a little bit into investing, or do I create an account to be able to like save for a home? What's the long game here? Both. Oh my goodness. Now we're definitely single.
No, both. One with two benefits, right? One with two benefits. So, I mean, that's how I saved that's how my wife and I saved for the down payment in our home, right? Was you figure out how much you can save every month, right? You open the brokerage account, you know where it's going to go. So you get your paycheck and you say, X thousands goes into this account, or hundreds, whatever it is. I mean, kind of like fitness, right? The most important thing, you know the saying, Rome wasn't built in a day.
Absolutely.
The full saying was, Rome wasn't built in a day, but they were laying bricks every day, right? So however much you put in doesn't matter so much, right? So hundreds of thousands saying, okay, it's the first of the month, it's the 15th, whenever I got my paycheck, I know this much goes to Schwab or Robinhood.
Yeah.
And here's my roadmap of what it goes into.
Yeah.
And if you're going to buy a home, right? If you know how much you're going to put away, you can use our return estimates. Again, unfortunately, they're lower for now.
Yeah.
But like, let's say it was going to take you 5 years and then you were ready to buy a house. The longer it's going to take, the more aggressive you can be, the more you can be in the stock market. Here's some more free advice, or as someone in our industry says, free jewelry, is the banks pay nothing.
Yeah.
You're allowed to open an account with the United States Treasury Direct.
You mentioned this. That's right.
Yes. And you put money directly through them. You can't do it through Robinhood or Schwab. You have to do it. It's one of the rare instances the individual investor wins. And my mom's not going to listen to this, so I can say this. I tried to guide her through how to do it, right? And it's kind of like, where do I click? Anyway, but for the motivated, it took me 5 minutes. You're allowed 10,000 per year in what's called an I bond or an inflation bond, and you can get 3.5% today with no risk as long as the United States government continues to exist and the Blue Angels flying overhead give me confidence. So you get 3.5%. And a lot of people are worried about inflation these days, Chris. If inflation rises, your interest rate automatically rises. So in this environment, remember we talked about the stock market, 4 to 6% roller coaster. Here's 3.5%, like a bullet, no risk. You're allowed 10,000 per person. If you have a spouse, 20,000. If you have one kid, 30,000, two kids, 40,000, which starts to get pretty material. So generally, the shorter the time frame for the money, the less risk you want to take, right? The longer the time horizon, the more risk you could take. But doing a proper budget, whether it's through Quicken or Excel or just looking at your bank statements, figuring out, and most people have a pretty good intuitive idea. And actually, this is probably another good point, and going to your meta point. A lot of people get stuck because they're not finance people or math people, or they think you need an advisor, or you have to complete a degree. I'm not an econ major. Like budgeting is really simple, right? It's how much, I mean, you kind of know, right? Do I have money left over or not, right? And then let's attack that, right? Is there anything, is there anything we can do to lower the burn rate? But I've found if you track your expenses closely for 3 months, you have enough information. We're pretty repetitive creatures, humans. So if you track your spending, as long as there's not a crazy event, but you can scrub that out, figure out what your excess cash flow would be, right? Do the numbers. So if we save that every month, how long will it take me to get to this goal, right? But to your advice, so having the brokerage account, putting that in, having a Treasury Direct account, I think is a home run. It's again, that's Treasury Direct I bonds. I can send you a link if you want to share it with the listeners. But using that kind of vehicle for money that's inside of 5 years and money that's beyond 5 years in a very simple stock index fund. You could use either US or global, depending. Those are practically free these days. So just creating those habits. And like you said, then your algorithm becomes real simple, right? At the end of the month, I have $500. That 500 goes into my brokerage account. Then the brokerage account, I buy more of what's already in there. That shouldn't take more than 30 seconds, a minute, a month.
Yeah. So a few years ago, one of the big CEOs of a big nutrition company, diet plan, got in trouble because somebody asked him what the secret to weight loss was, and they wanted this big, profound explanation. And it was like, just put the fork down. That was their right. Like that's that. Like I don't need to exercise more or anything. Like, no, just put it down, right? So people thought that was very condescending. They didn't like that explanation. So, and the same is with budgeting. Like, you just have to do it. Like most people, the problem with people trying to lose weight is just they can't put the fork down.
Right.
The problem with people who can't do their budgeting is just because they don't have the discipline. It's just every single first of the month or whatever your day is, the first Sunday of the month. The problem is, I think that a lot of people are scared to look at it. They don't like being punched in the face every month.
Oh,
right?
Sure.
They want to live this.
Yeah, it's like getting on the scale or taking your shirt off.
It's the same.
Yeah.
It's the same. And guess what? You know, it's funny. We as physical therapists don't see it from your side. You know, you're a client, right? Like I understand the concern when people come in, like I get it. Like this is scary. Like this is your health. Like I want to train 5 days a week. I can't stop training because of this foot pain. I get that. And the thing is, you're like, I don't want to see a therapist because they're going to tell me to stop. Like I just don't want to, right? Like I get that. You
I've
gotta
met
face it.
No, it's a great point, and the analogy works. I've met clients that have 1.5 million,
Yeah.
right? And they're embarrassed. Did I get started too late?
100%.
Do I not? So that feeling is sort of it's universal. Yeah, I haven't met anyone yet. Very well, maybe the guy who rents in Santa Barbara. He might be the exception, but I meet very few people who think I've got it nailed. Everything's
Nobody.
perfect. Yeah.
Nobody. Yeah. And I think that I think first and foremost, physical therapists need to understand that like it's okay to be vulnerable. You don't know it all. Just because you have a doctorate or a master's in something means that nothing in other worlds. I don't care if you're a dentist, you know nothing about the heart. Like that's not your specialty. And budgeting doesn't have to be a degree. It's a discipline, right?
Right. And that comes back to the humility too about your answer.
Yeah.
Like rather than doing all of the other, right?
Yeah.
Spreading your eggs a little bit, diversifying, because things happen all the time
Yeah.
that even if you knew what was going to happen, people guess the outcome wrong.
For sure.
But then COVID comes along, these things happen. So exactly getting all the tools and sort of knowing. And by the way, we've talked about a lot, but at the end of the day, it's right. All we've said was, right, we've said simplify your debt, not make it more complex.
Yeah.
And we've said open a brokerage account. If anyone listening Googles, right,
Yeah.
open a brokerage account, the brokers will be very helpful to pop up online and tell you how to do that.
Live chat. Yeah.
So this, to your point, in a way, it is like getting rid of the anxiety. To me, the best thing that reduces any financial anxiety, right, is taking all these abstract concerns that probably pop up. I mean, the average person who doesn't have a plan in place or hasn't gone through this, probably thinks about it, probably comes in and out of their mind every day, every hour, right?
Yeah.
All of a sudden you could have, one note card, one sheet of paper, right?
Sure.
Get money, put in brokerage account, buy X, done, right? So anyway, we've talked about a lot, but at the end of the day, it's incredibly simple. And your point about, like, I'm a CFA, I'm a CFP, nothing I've said, okay? Nothing I've said has required those credentials up to this point, right?
I understand.
It's almost, I have the courage to know, well, that guy is selling something, that person is full of, whatever. So it's almost having the confidence to know, no, it really is this simple. Like the fork comment.
Yeah, right. It's really basic. So, and I have 2 more points to touch on because now you're gonna be fired up over here. All right. So, the house, okay, this American/world dream, like we want to own a piece of land that is like ours, right? Because there's many reasons why people have this vision, right? So if somebody wants to purchase these things, one, to kickstart, right? It might be a condo, a townhome, a starter home, whatever that is. All right. So now we have 8% on the debt. We have put money into a retirement account with employer matching. We have a Robinhood or investment account that we're putting in a couple $100, right? And then everyone starts asking, when are you gonna buy a home? When are you gonna buy a home? So now so you have these allocations, and the debt on the home, let's assume right now it's at like a little over 3%. And right, so let's assume 4%. A couple years from now, we're back to semi-normal, and let's go 4% for easy math. And now you're like, okay, so the debt on the student loan is 8%. Now the mortgage is 4%. Do I dump or move the investment in retirement and dump into a home, because now I have an asset, right? Like that's everybody's, like, increases my net worth. I have an asset, but it's also debt, it's a liability. What do people do there?
Well, that's exactly right. So when you own a home, right, you own the equity, right? So you own the principal less the outstanding mortgage, right? The bank owns the rest.
Correct.
Right? And we mentioned to connect that to the forced savings comment, right? If you were to go apples and apples, so let's deal with an algorithm, right? Let's deal with person A, person B, and let's forget who their personalities are. If person A buys a home and person B rents a home, and the rent is less than all of the home expenses.
Yep.
And most people forget, especially the interest, to include that one.
Yeah.
Property taxes, which are high in California, unless you have a really old place under Prop 13. But I don't want to bag on boomers on this podcast, so we'll leave that out. If you take person A who buys and person B who's renting, right?
Yes.
Person A who's buying is not paying down principal. For the first 5 years, it's almost all interest payments, okay? Yep. So they buy a house for $750,000, and they're going to pull up their mortgage statement in a few years and say, well, now it says they owe $740,000, right? It's almost all interest costs. And on a $750,000 home today, not counting property taxes, you're talking about $3,000 a month. So if you go to person B, and let's say he can rent for $2,000, $2,500, all right? If he, she, or they take the difference and invest it, right?
500, yep.
And invest it in today's environment, I bet person B is going to end up ahead. What a lot of people forget is that if the rental's less, right, what matters is, do you take that excess?
Correct.
And what do you, if you go to the bar and drink it all away, well, now you've lost the person A, right? So it does take some discipline and some recognition. But if you say, so, and the thing is, so the guy buying a home today at 750 with a 3,000 mortgage, right? Also has property taxes, right? Of almost $1,000 a month. They might have an HOA. This year, my property tax bill went up $1,000 a year because of a sewer cost, right?
Wow.
The renter didn't have to pay that. So you really have to do it apples to apples. If your rent is equal to the mortgage or less, right? Not factoring in all these other costs.
Yeah.
If you're disciplined enough to invest that difference, right?
There you go.
It's not a fair fight until you do that. Now you have to take that difference and invest it, right?
Correct.
And you and your spouse, the team, right, has to understand that.
Yep.
But at these current prices, so are you familiar with Robert Kiyosaki, Rich Dad Poor Dad?
Yeah.
He was on Twitter the other day, and he said, everyone keeps asking me about buying homes, right? He goes, I own thousands of homes. I'm selling as many as I can. You want to buy homes when the market's down, and you want to sell when the market's up. You know, you guys are being crazy, to paraphrase, right? And this is Rich Dad Poor Dad, whose whole premise is, right? The poor dad is the guy who doesn't buy a home, and the rich guy is because what you pay for the asset matters a lot. Especially at these extremes. So to your point, if we were talking to a young physical therapist, right? Maybe a physical therapist who likes to skateboard, go to coffee shops, right?
Sure.
Very hip physical therapist you and I may know. You know, in this individual's case, right? If they can rent and start to get in that habit of 250, 500, whatever it is, I'm going to invest, right? When the market turns down, right? And the people that bought homes, about 70% of millennials and Gen Z that have bought homes in the COVID pandemic regret their purchase.
I imagine.
Regret it, right? Going from an apartment to a home, adjustment. Urban environment to suburban environment, adjustment. You can't call the super, right? You have to, you know, you're on vacation, a pipe bursts, right? You're the one that has to deal with it. People are waiving contingencies. Oh, there's termite damage. I know this because it happened to me. My wife and I looked at a home that had clear termite damage. Yeah. And someone said, we'll buy it, waive contingencies, right? Any damage is on us, right? It's no wonder. But people have a fever because they think, well, I need the rich dad, poor dad. I want to be the rich dad. I got to buy a house. If you were to rent today for something similar or less than the buying and invest it, you're going to come out ahead. When my wife and I moved to Oceanside from New York 3 years ago, my wife met a guy, you know those people who work on boats their whole career, and then you meet them on the land and you can see in their face, right? She said this person he met, you could see the stress on his face because he bought a home in 2007 because he thought the market's only going to go up, right? I understand. So this person, a decade later, right, told her, my home's finally worth more than I paid for it. And by the way, don't point it out to them. That ignores the interest. People talk about wasting money when you rent. Interest is a waste of money. This guy bought a home, 11 years, 0 return. interest costs, property tax costs,
Yep.
all the maintenance costs, appliances. So it's easy to tell a story of getting rich quick through homes, crypto, stocks, right?
Yep.
It works that way until it doesn't.
Yeah.
And we've so anyway. Yeah, it's good to add some cautionary stories, but I
Yeah.
would say once people realize, you can sort of disentangle it.
Yeah.
Right. When you realize that a home, part of the value is for savings.
Yeah.
Well, can you force yourself to save? Right.
Yeah.
And know yourself. If you can't, right. If you can't, well, that 401k and that home are your best friend.
Perfect.
Right.
That's huge.
And if you can, right, if you're the skateboarding hipster that we both happen to know, open the brokerage account,
For sure.
and have some accountability, right? You got to open the brokerage account.
Yep.
Oh, and any of your listeners, if they say, well, I don't know what index fund to buy, or they have any questions, Chris, I'm happy to, my website's mk-am.com. Any of them send me an email, tell me they listen to this podcast, I'll answer their question for free.
Awesome.
So no excuses.
Awesome. And that's huge. And there's a couple layers on that. First of all, thank you for giving your contact information. I think that's important. Stephen is an honest, transparent human being. So his information is pure and honest. So you said, I want to touch on this because we were talking to another team member and we were talking about forced savings. And I think it's important for people to know and be honest with yourselves. Some of us are not good savers.
Sure.
Right. And you're right. Somebody who says, I can get a house and pay a mortgage at $3,000, and you're like, no, I don't want to do that. I'd rather rent for $2,500 and I save $500. However, if you're one of those who, when a paycheck comes in, all your stuff goes out, and then you see this large number there because you have some excess, do you go out on the weekends and start having fun with the friends, buy the new shoes and the new watch or whatever it is? Then the home would have been a better idea for you. And here's why. Because you're buying things that don't appreciate. You're buying depreciating assets. You're just buying stuff that just loses value the minute you wear it.
Let's add cars to that list.
Yeah,
too.
Add a car. Like, why do you need a new car? Why do you need the newest car? Whatever it is. So I think, let's touch on that, because if you're one of those and you know yourself, right, you're not the best at it. And even if you try, you're not going to be the best at it. First, you got to, awareness is key. We're not good. Next, what can you put it into that forces you to put it in every single month that you can't touch and appreciates? So like you said, either dump it into the retirement account so you get % growth off of that plus employer matching, or buy a home. Now, there are some people who want the emotional aspect of owning a home. There's nothing wrong with that. Now, if you're an emotion-driven person and you're not good at savings, this home might be the best thing for you. And I imagine in your world, there's what people need and what people want, Stephen, sure. I imagine. And you're trying to play the best of both worlds. And like, listen, if you were okay eating top ramen and driving a $200,000 mile car and having millions in wealth, or you need to have the new car and do all these things, like somewhere in the middle, I can help you.
Right. Yeah. And to your point, again, this individual who drives the car with a lot of miles and rents, retired before, at or around 50.
Wow.
Travels all the time, gives money away to nonprofits. So it's a very rich life, right?
Huge.
Right. And so that's the question is, what matters to you? Like for my wife, other than the kids, vacations are number one.
Huge.
Right?
Yep.
So we've been on safari in Africa. I took my mom to the Galapagos Islands. Don't think twice. Almost don't even look at the costs for those things. Sure. Right. So it does come down to who the individual is. On the forced savings vehicle, I've seen some interesting things with some of my clients, right? Where they run into some money issues temporarily and they need cash and they say, I'm going to figure out how to get this somewhere else. And they don't want to take it from my firm because they've created the forced savings, right? As like a Chinese wall, right? An invisible barrier. They said, no, it goes to you. That's for investments. right? And so that's the other, again, it comes down to your discipline, but if the money that you have goes into Schwab or
Yeah.
Vanguard, and since
Yep.
we mentioned a few, I'm just going to Schwab, Vanguard, Fidelity, BlackRock, Bank of America, Merrill Lynch, Robinhood, if you see it as going in,
Yeah.
that it can't come out, right? And like
Beautiful.
you said, if you put that money, you get the money, you put it in first day, it's so easy with apps now, right?
Yeah.
Then you go to the bar, you'll just find a way where it'll work out, that maybe after drinks you get pizza, or
Correct.
you know, you just find a way to live within those means. So
Yep.
you can create that forced savings for yourself that way. I mean, when
Correct.
I was saving for, and that's the thing is, if you take a slug towards your down payment for your home, right?
Yeah.
You build that step. You don't want to see it come undone, right?
I understand.
I'm sure you've seen it with people you've trained and worked with in the clinic.
Yeah.
But once someone starts building the fitness, like I bet you Jeff Bezos will always be buff, right? He's seen it now, right? He doesn't want to go back to dorky, skinny, hunched over Jeff
Correct.
Bezos, right?
It's about keeping that. Yeah.
Yeah, and
Yep.
that's the other thing is I want the other beautiful thing about having kind of a hybrid approach, right? Setting up the brokerage account, putting something. Let's say you put $1,000 in.
Yeah.
You check your account in a year and you see 1,100, 1,200. If you're so used to, no, I throw money in this pit and my debt really
Correct.
doesn't go away, to see the opposite, right?
Right.
You never know what's going to click for someone, right? That could be the thing that also turns on the switch, right? Because all that extra interest is the vacations and the,
Correct.
you know, the you can be the guy or the girl buying the drinks, you know. So it's with debt, it prevents that. I mean, it's like, I think the analogy, you can't even show up at the gym, right? And maybe opening the brokerage account and getting the index fund is like, okay, I'm gonna get a membership, or I'm gonna start one day a week, right?
Correct.
And it's like, until the debt's off, you can't go full Bezos yet, right?
Correct.
You can't go all out, right? But getting that taste of it, right? Again, it could, some people, when I see a debt balance go down, right, that feels good.
Oh yeah.
But that might mean nothing to someone who's like, well, I can't touch it, I can't feel it, it's so far away. So, you know, experiment what feels good, right? You know.
Correct. Correct. And it is up to the person. And some people need that instant gratification, and that's always the challenge. Is like that's why, you know, crypto and investments are so tempting. You're like, I have 8% debt plus 18 on the credit card, but if I just buy one Bitcoin, I could have doubled my money and put that over. And
my dad, who's seen more market cycles than I have, he has said since the beginning of time, young people always gravitate to anything that looks like it'll accelerate their getting rich, right? So the meme stocks, right, before the SEC was created in the 1930s, right, everybody walked around passing around tips. You know, you gotta buy this railroad, you gotta buy that one, right? Like it all just cycles. But to your point, I mean, it sounds amazing, right, to get a windfall and, oh, student debt gone, you know, now I can get that nice house by the beach. I mean, and that's the and some people do get lucky, they do get wealthy,
of course,
but those stories become very powerful. People chase them, and you know, hundreds or thousands of people end up just getting set back, right?
Correct.
And I think you put something powerful too earlier is in the meme stock craze. So even Barbara Streisand, and now we have a younger audience, so I should ask, do you know who Barbara Streisand is?
Some people are even saying, isn't that a song?
Barbara Streisand, you know, singer, theater career, very, very famous. She was day trading. So we did a podcast about this at my firm. She was day trading again. The last time she day traded was 1999, and so it affects everyone, right? And so we had clients calling like, what about this stock? What about that stock? Our advice isn't don't do it. It's just do it at the right size. And so if you have a pot of money, $100, $1,000, and you want to see how many times you can roll it into, you know, the right cryptocurrency on Coinbase or the right stock on Robinhood, go for it, right? Just realize that's kind of it's one part lottery ticket, one part fun. It's not your plan.
Yeah, and that's wow. Yeah, so you said that there's a difference between investing and planning. Very big difference. and like the luck and the fun, that with investing, that's not planning. You're rolling dice at that point. And if you're going to plan, what we're talking about here is I titled this like financial planning for the physical therapist, not like financial investing for the physical therapist, because that's a different world. Because if you're in debt, a lot of physical therapists are in debt with credit cards and or debt plus, sorry, and or student debt and or mortgage, or they want to get the mortgage. They're trying to figure out where to put the money. If I have 500, do I roll it into investments and everything else, or do I put it into a house? It depends. Are you a good saver or not? If not, buy the house. Force yourself to put it in there. If you want to roll around in some nice, shorts and, things that are going to lose
some
value.
Viore shorts.
Yeah, Viore, like, gosh, man, you got me onto those Vioris. So I think that there's never anything wrong with these scenarios. And I just see it with the current generation. I am a super saver. Like super saver. I love it. I love saving because I love seeing that. Funny story.
I told you about umbrella insurance. And you went out and got it in a week.
Hey, if smarter people are telling me what to do, I'm gonna do it. That's a lesson I learned. You told me about this conference you went to. I'm not gonna say no. It's just when, right? That's just when people are trying to help you, you naturally just take it. Just say yes. Okay. And so what we're trying to do and share this with you is that don't be tempted with all the things that are sexy and like currently happening. I've worked with a lot of physical therapists. I work with a lot of aspiring entrepreneurs and people who want to do this. And they're always looking at Instagram and YouTube to tell them where to go, which is the worst thing possible because those people have an incentive to do this. Like they're trying to bait you into their own products. Like if you don't understand that, like that's what they're doing, right? And so when you're looking at financial planning, it's not sexy. It's not. And there's people on here that understand that clients don't like talking about outcomes if they're not achieving them. So if they're not losing weight, you don't want to go on the scale, right? Like people don't want to go on the scale if they're not doing well. So me personally, I look at my bank account every single day. Why? Because I want to look at scale. I need to know, did I get 0.01% growth on it? Or did I lose? I just need to know we're heading in the right direction. Just get on the scale every single day. And if you're not looking at your bank account, you're not looking at your debt, you're not looking at your dashboard. I call it my personal profit and loss. There's a book that's out there, Mike McCalloway. It's called Profit First. Anytime something hits my bank account, it goes to 7 different accounts. 7. And it goes into, vacation pot, danger zone, if we need anything down the line, college, funds, whatever it is, and all those things. And I'm talking like $100. It doesn't matter. But what happens is I never get to see that. And it's what you talked about earlier, Stephen. If I don't see it, I can't appreciate and think about what I could have bought with it.
Right. And you get all these future experiences.
100%. But that's
and
not
you start
sexy.
to connect. It's not sexy at first, but you start to connect them over time, right? Because then you remember, oh, when I was in that Jeep and we saw a lion, kill something in the wild. You're like, that's because you took the 7 account strategy and put your 500 or whatever it is away a month.
Yeah. And so for you guys listening to this, you don't have to have 7 accounts. You don't have to be an entrepreneur. You don't have to be anything more than disciplined. Just put the fork down, look at the scale every single day and decide if you're a forced saver or not. Do you need to buy a home? Cool. Sounds good. Work towards that because you're going to spend your money on fancy food or whatever it is, whatever that means for you. So the challenge I see a lot of time now with physical therapists is that the challenge is that since they have debt and they're not good savers, they want to look for the highest paying job. Well, sometimes the highest paying job isn't the most sexy. So they have to go into these not so great jobs and have to work all this. So they're not really happy about it. So they got into the profession for the wrong reason. And the reality is it's simple. You can do it, but your habits have to be better. And most of us don't come into this profession because we were really good at finances. That's not, sorry, Stephen, we're not that's not our jam. We're really empathetic humans. We want to help the world and we'll do it at no cost.
Right.
And what happens is when we take that approach to finances, it doesn't work in personal finances. You got to own your finances. You got to know every single point. Why was this 10 cents more? Like my normal recurring, why is that $1 more? I know when Netflix goes up $1 because I look at the thing every day.
Right.
I'm calling I have to know.
Well, and that's the airline oxygen analogy,
Yeah.
right? Is so this woman that I worked with, rather than focusing totally on her patients,
Yeah.
she's running around thinking, can I get the financing so I can
Mhm.
become an owner to sculpt the clinic in the way that I want to, but she can't because of those previous decisions. So you've got to put the oxygen mask on yourself first before you can help other people.
Yeah.
I mean, stress from finances and
Yeah.
being in debt can start to impact your personal life, your work. So to your point, and I struggle with it too. I'm not I try not to be, I don't think I'm a selfish person, but
Yeah.
in this case, by being selfish, you get
Yeah.
to be more selfless. So you
have
get to
to.
help more people. Yeah.
Yeah.
And that's why it comes all circles back to this. And I'm asking you one question.
Yep.
We've been talking for a while. I don't want to take up all your listeners.
No
And by
worries.
the way, anyone who's still listening, great job.
You made it.
But this is why kids is
Yeah.
such a big, why it's the first on the list of 4 reasons to get a financial advisor. Is they've done studies when you show someone a picture of their kid,
Yeah.
they make the right financial decision.
Yes.
Right. So that's why it's such a big motivator, right? You start to care less about bars and drinks with friends
Right.
when that happens. Okay, so I'm going to ask you a question that I
Yep.
know you wanted to cover on the podcast.
Yep.
And, well, I'm going to ask if you want me to cover it, which is, say someone listened this far and they think, you know what, just not a numbers person. I do want to hire an advisor.
There we go. Yeah.
Should we touch on how to
Yes.
pick an advisor?
Because in the physical therapy world, there's not a credential that tells you you're more qualified. In sports, there might be, or orthopedics, but like somebody's Google searching this, they don't know. So tell me, if I'm a physical therapist and I want to hire somebody like you in my area, and I've met one of those 4 qualifications, or I want to consult to see if this is something for me, what do I look for? Like, what do I Google? How do I interview them? What's the normal standard process? Tell me more.
You used a good word, which is credential.
Okay.
And rather than, especially for the financial plan, and the financial planning, rather than emphasize the credential, I'm going to emphasize the different acronyms in terms of the that it's not about the credential, it's about the responsibility that comes with that acronym and how you might lose it. So and I'll come back to the credentialism. There's and it's a great point because there's a lot of really thoughtful people, Tyler Cowen, a lot of economists that have sort of attacked credentialism. And I think to your point, a lot of the most successful money managers don't necessarily have an MBA. They may or may not have a CFA. The credentialism in finance is less important. It's about the accountability. There's a thing called the fiduciary standard, which says something to physical therapists and doctors and the layperson that might sound incredible, that this needs to be said. But the fiduciary standard, which is not law yet for the United States of America, says a financial practitioner has to put their clients first. That's not the law. If you show up in someone's office and he says, I'm a financial advisor, right? Legally, he's not obligated to put your interests first.
That's crazy.
Right? If you're a CFA charter holder, if you're a registered investment advisor, RIA, in the state of California, every state has different rules. If you're a CFA charter holder, registered investment advisor, the state of California, and the CFP board just adopted last year for the first time in their history, the fiduciary standard.
That's crazy.
Edward Jones, which is, I don't want to say anything disparaging about them, but Edward Jones fought the CFP board and said, if you make CFPs hold to the fiduciary standard, we're going to fire all of the CFPs that work at our firm. Why? Because let's say you come into my office, right? And Chris, I'm going to look out for your best interests.
They can't do it.
No. Well, here's the thing. They might do okay by you, but then the firm says, you got to send them next door to our whole life insurance salesman. And then next door to, some other product salesman that you don't need. Once it's the fiduciary standard, this is all that happens. Now the CFP is bound to say, Chris, I'm going to send you next door, but my firm gets a commission if you sign up for that. And in your situation, you probably don't need whole life insurance. If you're bound by the fiduciary standard, you're supposed to disclose. You're supposed to put the client's interest first. there was a proposal from the Department of Labor to put the fiduciary standard nationwide for the financial industry.
Yep.
It has not become law. It's been fought tooth and nail by the finance industry. But so a really simple rule, and again, it's not about what this person can do for you with the credential the other one doesn't have.
Yep.
It's that someone with a CFA, now a CFP, or a registered investment advisor in California is legally bound, right? Or they'll lose their charter, they'll lose their registration. Wow. The state of California will take away your RIA status, right? If you do things that violate your client's interests, like don't disclose to them other commissions you make. So in this case, I can't, the better word than credential in this case escapes me. And I think it's a good point. All of these people will tell you why they have better credentials.
Yeah.
And I'm an RIA with a CFA and a CFP. I would make the case that they do, but more importantly is that they're bound by the fiduciary standard. So,
I see.
And if people aren't sure, right, just ask whoever you're talking to or you get referred to, are you bound by the fiduciary standard? You know, if so, like how? Just ask them, right? So that's one, right? You want to make sure it's an entity bound by the fiduciary standard. If you don't know, ask them.
Okay.
And if you still don't know, send me an email. I'll tell you. It's very easy for me to find out, right?
Yep.
Just like you know all the credentials, right, that in your industry. Two, is the person fee only, right? Which sounds like a strange term. Yep. I used it around my wife once. She's like, what does fee only mean, right? Right. So a fee only financial planner takes money from you, and that's the only revenue they can make, and they give you advice for that. A non-fee fee only financial planner can get a commission for sending you to an estate planner, getting a commission to send you to a tax person, get a commission for sending you to an insurance salesperson, right? I see. So bound by the fiduciary standard, fee only, the only money they're going to make from you is what you're paying for that service. Those two things. There's also a website, at the SEC broker check. Okay. If you Google SEC broker check and put a name in, you can see the advisor's history. So this is a true story. There's a guy here in San Diego who had, if you pulled him up on broker check, he had been kicked out and fired from previous firms. He had paid fines to the regulatory agencies, yet his clients, I'm assuming, because nobody would do this on their own volition, the clients didn't know how to background check this advisor. The advisor managed money for multiple clients, but one in particular. He actually took money from the client's account and bought a new Camaro. And then when he got bored of the Camaro, he tried to sell it back to the same client that he stole the money from. And that's at that point when the client figured it out. And he's now been thrown out of the industry. But if you looked him up on, I pulled up his name when I read the article in the San Diego Tribune. I pulled up the broker check. It was all right there. So I can only assume that people, and the thing is, that guy wasn't an RIA. He's not a CFA. He's not a CFP. Right. Broker check, red flags. But how are you going to know, right? You almost foresee a service where you have like an agent where all they did was help you find a credentialed, honest, like the thing is, I could build you, like I could do it in a minute, right? Yeah. But if you're not from the industry, how would you know, right?
Right.
So anyway, SEC broker check, are they a fiduciary? If you still don't know, and see what kind of car he drives. If he drives a Camaro, but if anyone's not sure, they can shoot me an email and I'll tell them.
That's huge because in our industry, we're regulated by a national exam and then state exams right after that. So if you wanted to Google a physical therapist to make sure they were licensed or had anything behind them, kind of like the Better Business Bureau of credentials for us, you can go to any state board and legally look up any by name license and justify and make sure validate that they actually licensed and they had no complaints, anything big happened to them, and that's public knowledge. In your world, the standard is different. The credentials are different. The work they can do is different. Yes, a CFP can take an exam and all these other things, but doesn't make them ethical. And what you're saying there is, having the fiduciary is a standard that helps you select somebody that is going to put you on the right path.
Do that work first, right? Yeah. Because if you clear those hurdles, right? Yep. I mean, that I feel so. So the Camaro story is funny to me. I don't know why, but especially because it's a Camaro. I mean, it's of all the cars you could get. No offense to anyone who owns a Camaro. Yeah, I had a friend that owned a Camaro once. But so many problems in the industry or bad experiences could be resolved or prevented if people knew those steps. And like you said, I'd never heard of, the that kind of medical board to vet a trainer or physical therapist. So my hunch is 99% of, I mean, the government doesn't take out advertisements, hello, this is a public service announcement, go to SEC broker check. So that I think can eliminate, I don't know what percent, but I'm willing to say, the worst situation. So let's say you clear those hurdles, right? You go on SEC broker check, we look up a name, John Smith, clean. Oh, he's got a CFA or CFP, and he's a registered investment advisor in California. John Oliver on HBO did a whole special on the investment advisor industry, right? A financial advisor means nothing. A registered investment advisor is a loaded term that means something, and it depends state by state, like you were saying. But but let's say you do that work, and you're going to have a meeting with someone, clean record, RIA, ideally on staff, they have a CFA or CFP, both because of the ethical requirements and also it shows you they've studied some of the relevant material. Now you can actually begin vetting them, but don't do it until then. And something that comes into play in your industry, I'm sure, it just like a trainer in New York referred me to your outfit in San Diego, and I trust that person, right? Family or friend that has, and not an uncle or a brother-in-law, but if someone has worked with someone and has had a really good experience and that's both ethical and done good work for them, I mean, that's the best, right? But absent that, all the services that attempt to screen advisors for you online, they have an agenda, right? So you do the work, you go to meet with the financial planner and advisor. Like in your case, we're dealing with a common template, right? So if you were to meet with them, hey, do you work with a lot of physical therapists? You work with a lot of people in this age range? One of the specialties of my firm is working with tech employees who have a lot of ISOs and RSUs and ESPP, and often we have multiple employees at the same company. So if someone from that company wanted to work with us, I mean, we could just get right into the details. So make sure they're ethical. Hopefully this is some clues how, and then feel them out. Ask them honestly, hey, do you work with people with my profile, right? And then again, make sure they're fee only, right? And I'm sure people can be embarrassed by this, but just ask, right? Hey, do you get paid by anybody else? Or am I the only one paying you in this relationship? The old school trend in the industry, and thankfully it's moving away from this. Again, the CFP didn't adopt the fiduciary standard until last year, right? And they've been around for a long time. The old school standard was you go into a bank or anywhere, hey, free financial planning, right? I'll make you an investment plan for free, right? And then you look at the portfolio, right? Let's say you go to, I don't want to use a real name. Let's say you go to, Green Oak Bank. Suddenly there's Green Oak Bank mutual fund, stocks, Green Oak, bond fund, right? So they're making money that way.
Of course.
And then also, oh, hey, we also have an insurance arm. Like, let's get you the whole life insurance. So, it's kind of like people intuitively know, although they still use it. If you go on Facebook, right? Or if you trade a stock on Robinhood, it's free. Okay. Right. It's not free. Understand how they're getting paid.
It's when a nurture process.
When you deal with the fee only certified financial planner, right? The check that you write them should literally be the only money that they make on you. And that's just a totally different relationship. So also that's another rule of thumb. If someone is giving you something for free, other than this podcast, obviously, if someone is giving you something else for free,
question it. Yeah, and that's huge. And so, Stephen, this has been huge. I think I have a couple takeaways that anybody on the team, anybody who ever asks, maybe that I mentor, a couple takeaways that I have for the profile that we're talking about. If you have debt, put the fork down and just do it, right? Set up your plan and just pay down the debt. Know what your excess cash flow is going to be, and then allocate that to something that's going to grow. If you're not going to do that and you're not good at saving, then put yourself into forced savings, something like a retirement account or a house or whatever that is. if you're good about those things, then pay down your debt, go towards the principal, get whatever you can out of that. If you have a retirement account with employer matching, use that as a vehicle. Set up a retirement account so that you have something that you, when it's ready and you feel the urge to, that you can start dumping some stuff in there. Either way, you have things that are growing, you're paying down debt, and you have things that are appreciating and growing over time. Now, like you said, it's going to take a long time to build Rome. So you're just laying bricks every day. So to put 50 or 100 or $25 if you can't put 25, I mean, that's a budgeting problem like that.
It's like the guys that run a mile for the first time, and it's like you gotta celebrate it, right? Get started.
For sure. Let's go. Right, 25, and then start cutting down the Starbucks, cutting down the other stuff, whatever, and then start dumping 150 and see that growth over time. Great. Now we're in a good position. So when somebody needs to come to you, we talked about those 4 reasons. So when they have a kid or they inherit something, they're ready to go. They have low debt, they have assets or appreciating assets, and now they have a place to start. So when they come to you, you're like, oh, wow, you've done your homework. The portfolio looks good. Now it's easy. Let's just put you here. Like, here's the answer, and do your magic and whatever you do. I really just wanted to create this podcast to make sure that I have this discussion with numerous physical therapists, and they just sometimes have a hard time listening to just eat the veggies and just like put the fork down and just budget. The answer is really easy. Pay down your debt. Stop looking at what's sexy in a home and investments. Stop doing that. If you have employer matching, use that and pay down your darn debt. It's too easy to go on Instagram and YouTube to find something that tells you otherwise. That's probably trying to give you something for free so you can go in their vehicle and learn about their program and all their new stocks that they're wanting to do. And it's the best because it's 13% to 18%. Yeah, but it's current time. If you're planning is different than investing. And that's what Stephen has brought up to today. Those two are very different things. And planning is the long game. Investing is like the ice cream, man. You're just there for the short-term gratification.
Yep.
If you do it properly, put it into your planning. Make sure it makes sense. And people like Stephen are your best bet. And you don't really need them until you have one of those 4 items or criteria. There's nothing wrong with consulting. I've talked to Stephen about that. There's nothing wrong with consulting. But you know what they're going to tell you? Just pay your debt. Like, I'll take your money, but I'm going to tell you what you know. Pay your debt. You got to exercise and put the fork down.
If you need a coach, right? If you need a coach or accountability, yeah.
I'll be your accountability person. Sure, sounds good. But some people need that. It's forced savings. Yeah. It's the same thing. There's nothing wrong with that. I have no problem in treating people, as long as I'm transparent with them, that I will be your person to be your accountability, because I know you're not going to do it on your own and you need this and it's for your greater good. Fully transparent. I will 100% do that for you.
Yep.
And I think you would do that too.
Yeah, absolutely. And you can find people that are reasonable, that'll work for the hour.
Sure.
You can find people that'll
Perfect.
that have programs for younger early savers that are really affordable. I thought your summary was excellent, Chris. That's well done. And one additional thing, I promise you, if the San Diego real estate market, tanks, or the stock market tanks, we can come back and do a flash podcast, and we can say, new advice, take some money and invest or buy a house, right? I promise you we'll do that.
Yeah. At this current state, this is kind of the recommendations, but it's 10 years from now, 20 years, it's all going to be the same stuff. Don't try and reinvent the wheel. So Stephen, thank you so much for your time. We thought this was going to be like a 15-20 minute. It turned out, I don't even know what it is, but Stephen, thank you so much, man. This is so helpful for people around the country and around the world. I appreciate your time. And then just remind us, how do we get a hold of you? Like, what's the website again?
So the website, everything's on the website, and the website is mk-am.com.
Awesome. And then you have a podcast of your own?
Podcast and blog are both on the website.
Do you remember your podcast name of it? It's like At the Corner of something.
We just changed it.
Okay.
I was just getting my artwork done on Fiverr.
Okay.
So we've got a brand new website, new blog. The podcast is just the MCAM podcast, and my partner is Mark Cooperstock. So that's where the MK comes from. So if people want to hear more like this, and if they want any of these topics in more depth, right, we're always looking for ideas. Again, shoot us an email, suggest something. And Chris, it's my pleasure to be here. And I know your main orienting goal is to help people. So hopefully we can help some people through this podcast.
Awesome, man. Thank you, Stephen.
Thanks, Chris.